All right. Hello and welcome to our webinar today. My name is Matt Hilland. I'm a partner and financial advisor here at Arnda Moat Wealth Management. And today we're talking about a topic that's commonly grouped into what's called late stage college planning. And college planning is much more than just saving into a 529 account. If you have a child nearing college age, saving in a 529 over the last decade or more was obviously very important. But today we're not going to talk about the benefits of long-term savings into a 529. Instead, what we're going to talk about is how you can now use those assets that you've saved up and in combination with multiple tax credits and deductions that are available to you to take full advantage of this tax-free growth you've gotten in your 529 along with other tax benefits you can recognize today. And this is very much just like retirement planning. For a long time, if you're saving for retirement, you're concerned about saving, putting money away, and then one day the switch flips and now you're taking money out. And this switch introduces you to a whole different set of things to consider that you've probably not thought about before. There's income tax considerations, withdrawal strategies, and there's really a lot to consider. And the same thing is happening now with college planning when it's time to start taking money out of these accounts. And so that's what we're going to get into today. First, just for a quick disclaimer before we get started, if you've been attending any of our webinars before, you've heard this already, but financial planning is very specific to the individual or the household, and what works for you may very well not be the best course of action for someone else. And college planning is no different. In fact, I think it might be as complicated as any other tax planning strategy. The IRS has a publication 970, that's just on the tax benefits of education expenses. That's all it's on, and it's 93 pages long. So just to give you an idea what we're trying to distill here in 15 or 20 minutes for you. On top of that, every household has different amounts of savings, different types of savings, like 529s or taxable brokerage accounts or savings bonds. And every household has different income and income sources that make different opportunities, available or not available to them. So it's impossible to make a webinar that will be exactly right for you. But what we hope is that we can show you some possibilities and some options you haven't thought about, and that you can come to us for help to craft a specific plan for you. And so we're starting our planning around 529 accounts because this is definitely one of the most popular ways that people have been saving for college. And that's a good thing. If you have a 529 account you've been saving in now, now you're finally starting to use it. And as you probably remember, you've likely been receiving a small state tax deduction for contributing to these accounts, and the assets in there have been growing tax-free for a long time, for as long as you've been saving in them. Now you get the third benefit. Money can start coming out tax-free as long as it's used for qualified education expenses. What exactly is a qualified expense? The IRS defines it as an expense that's required for enrollment or attendance. Tuition is the big one here. There are other odds and ends. Books are another cost that counts. But for most, it's this tuition payment that's going to be the big check that you have to write each year. But how do you know what is considered qualified or not? Most of the time, determining the majority of qualified expenses is very easy. Come tax time, you'll be given a 1098-T, which is shown here, which outlines the amount of qualified expenses that you paid. Though there could be exceptions or other items to this, this is a really good place to start. And this is something that's important for you to go through with your advisor or your college to make sure you know what's qualified and what is not. And like any other time you're trying to make plans around the tax law, you have to know that things can and probably will always change. New in this last year was a big change for those with 529 accounts. Now up to $10,000 in 529 assets can be used after graduation to pay for student loans. So we'll talk about this in a specific example later, but this has opened up another strategy for college planning that just simply did not exist 6 months ago. And so now you can use 529 assets not only for the 4 years your child is in college or you're in college, but also well beyond as you're paying off your student loans. And now you have extra time for these assets and 529s to grow and compound if you want. But one important caveat before we go along, because we're going to be using the term qualified educational expenses quite a few times in the next few slides, but depending on what benefit we are talking about, what counts as a qualified education expense can be different. Now, this is not us making this confusing. This quote here is copied and pasted right from the IRS publication. And if you read it, notice that it's saying what counts as a qualified expense for some tax breaks does not necessarily count as a qualified expense for others. For example, room and board is one that counts under some tax credits and does not count in others. And so this is just one more reiteration to make sure that you talk with someone, a financial advisor, or at least your college, to make sure you know what expenses are classified as. Moving on to credits that you're going to be able to take advantage of when you or your child are in school. If you're paying for college, the primary benefit you want to look at is the American Opportunity Tax Credit. This is available for married households with a MAGI or modified adjusted gross income of under $180,000, half that for single households. The credit is available for only 4 years for each taxpayer. So if your son or daughter goes to school for 5 years or does graduate school, you can only claim this credit for 4 of those years. The credit gives you a dollar for dollar tax credit for the first $2,000 in qualified education expenses that you pay. That means if you write the University of Iowa a check for $2,000 next year for tuition, the government will give you $2,000 back as a tax credit when you file your taxes the following year. So this is very valuable. It can provide up to $2,500, but you need to spend an additional $2,000 to get that last $500 in credit. So in total, you can receive a full $2,500 credit if you have $4,000 in higher education expenses, which if you're paying tuition at most schools today, you're probably going to have. And now an important point, you cannot claim this credit if you pay for all of your qualified education expenses with a 529 account. And maybe now you can start to see there's some planning strategies opening up here. Even if you have assets in a 529 to fully pay for a year of school, you might not want to, because if you pay $2,000 out of pocket, the government's going to give $2,000 right back to you at the end of the year. Let's look at a specific example here. For example, let's consider a family that has done very well saving for college. They have $40,000 in a 529 account, and now their child is in college and they will have qualified education expenses of $20,000 per year. How should they pay for school? Well, it's not hard to imagine a family is maybe eager not to have a tuition bill for a couple of years and rely solely on that 529 to pay for the first 2 years of expenses. That's what we're showing in this table here. For years 1 and 2, the family pays nothing out of pocket and uses the 529 for everything. They think this is great because they don't have any bills, but look at this far right column. Because they paid no out-of-pocket expenses, they can't claim the American Opportunity Tax Credit. Then in the last 2 years, they're stuck paying everything out of pocket. Here they get the American Opportunity Tax Credit. In total, this household pays $35,000 for school. They pay $40,000, but get a total of $5,000 back from the tax credits. And it's important to note here that out-of-pocket expenses, as we show here, does not just mean money out of your free cash flow during the year. It can also mean money from student loans, or it can also mean penalty-free retirement account distributions as well. So if you're like most households who will rely at least partially on student loans to help pay your college expense bills, this strategy is still available for you. Let's look instead at what would happen if this family spread out their 529 and paid some amount out of pocket each year. In this example, our household is now using $10,000 of their 529 account each year. This means they have to pay $10,000 out of pocket each year, but it also means that because they're paying out of pocket each year, they qualify for that American Opportunity Tax Credit each year, which gives them $2,500 back. This strategy allows them to effectively save $5,000 on their total college tuition costs, since they qualify for that $2,500 benefit for 2 extra years. Here we've brought down their total tax adjusted or after-tax cost of college down another $5,000 to $30,000. Besides the American Opportunity Tax Credit, there are other benefits that are available to you that you'll want to know about just in case you're not eligible for the Opportunity Credit. The first is the Lifetime Learning Credit. This can be used an unlimited number of times. So if you take an extra year to graduate or if you go to graduate school, this is a tax credit that you want to be aware of. The income limits are a little lower and the credit is a little bit less than the American Opportunity Credit, but it is still very useful for those that are eligible. And you will see this is a common theme as we go through a few of these other tax benefits. You cannot double dip between all these credits. And that is, if you claim the American Opportunity Credit, you cannot also claim the Lifetime Learning Credit in that same year. If you claim Lifetime Learning Credit, you can't deduct your tuition expenses. If you pay for everything out of a 529, you cannot claim the Lifetime Learning Credit. Another option is to simply deduct the tuition payments that you're making. This would be for those who are too high of an income to qualify for the Lifetime Learning Credit, most likely, because this is available for households under $160,000 in AGI. And this provides a $4,000 annual deduction for you. With that income, if you're in the 22% tax bracket, this deduction is worth about $880 for you. And lastly, of the tax credits that we want, or tax credits and benefits we want to run through, is a benefit that exists for savings bonds. There's a few special rules here. The popularity of savings bonds have gone away a little bit, but if your kids are college age, you may still have these lying around, or maybe you planned ahead and bought them as a way to save for college. If savings bonds are used for qualified education expenses, the interest that you earn on these bonds, which would normally be taxed at your federal income tax rate, is eliminated. So if you purchased $5,000 in savings bonds a while back that are now worth $10,000 today, if you just cash them out, you would be subject to a little bit more than $1,000 in income taxes, depending on your other income and where you fall in the tax brackets. However, if you use them to pay for qualified education expenses, they're tax-free. This saves you about $1,000. And very interestingly, it's specifically written in the IRS publication that using the proceeds of savings bonds to contribute to a 529 is considered a qualified expense. So you can get the tax-free growth on the savings bonds and then cash them out, contribute them into a 529 account, and get your state income tax deduction on the 529 contribution. And so we've been over a few benefits, but how does this all fit together for you to use to your maximum potential? So remember our original example where the family has expenses of $20,000 per year and $40,000 in a 529. Now we're just adding some savings bonds to help show you how an additional layer of benefits fits into an example here. In our original example, this household ended up paying a tax-adjusted $35,000. What can this household do to get the most bang out of their buck for their savings? Well, we showed initially how simply spending the 529 out over 4 years instead of 2 years qualified them for an extra $5,000 in tax credits. What else can they do? Another thing a lot of people don't think about, you can continue to contribute to a 529 account even while your student is in college. There's no requirement for money to sit in a 529 account for a set amount of time. So you can deposit $5,000 on a Monday, take the state tax deduction, pay tuition on Wednesday if you want. This opens up 4 more years of tax deductions for this household. The value of this is going to depend on what state you're in and the tax break that they give. For Iowans, this could be worth just under $600 per year. And they can use savings bonds. They can take advantage of tax-free interest to reduce their taxes by $1,000, then contribute the proceeds to a 529 to get the state tax deduction. For our example here with $10,000 that have doubled in value, this would be equal to about $850 for this couple. And they can utilize federal direct student loans to help make the out-of-pocket payments as well. Remember, using loans still leaves you eligible for the American Opportunity Tax Credit. And that, remember, loans can be paid through a 529 account. So you could leave the assets in a 529 to grow and compound longer. And maybe most importantly, it can help you as a household be more comfortable paying this big college tuition bill. We've been assuming, $10,000 a year for out-of-pocket costs for this family, but that's not necessarily an easy thing to do. And loans could help spread out these payments over, at least several more years and help you take advantage of more benefits like deducting student loan interest also. Student loans get a really bad name today because how they've been, irresponsibly used, but ultimately a reasonable amount of student loans combined with a college savings plan may not add significantly to your total cost of college and can certainly make your life less stressful as you're paying the bill. So what does this all look like when it comes together? I've added a few columns to the table below to show how these added benefits fit in and how they can be implemented. We've added a column for 529 contributions, which are just to show money paid into the 529 and then immediately taken out to pay tuition that same year. And then we've added savings bonds, which are cashed in and put directly into the 529 to get the state tax deduction. So notice that in those four middle columns, the total always comes up to $20,000, just like our first example. But by spreading out the money into different types of contributions to be able to take advantage of what is available for the sample client, ultimately their after-tax cost of college comes in just under $27,000. That's $8,000 less than our first example. And so although we went through this really fast, I hope this helps you realize the potential value in sitting down and thinking through all the ins and outs in a college plan like this. And that's why we're here. This is what we do for families every year. There's a lot of things to juggle in a college plan, and we would love the opportunity to help guide you through this. We at Arnold & Mote are a fee-only fiduciary independent financial advisor. As fee-only, we don't accept commissions on any products we recommend or suggest. As fiduciaries, we are required to act in your best interest at all times. We would love an opportunity to help you through this and create a college plan that's right for you. So thank you for listening today, and we look forward to helping you.